Okay, so in this video, we're going to set up a strangle strategy based on just tweaking a bit the straddle combination we had before. Now, a strangle strategy using options involves a trader buying a put and a call with the same expiration date, but with different strike prices. So it's basically the same as what we have here for the straddle, except we have two different strike prices for the call and the put. The call has a higher exercise and the put has the lower exercise. Okay, so that's easy to set up here. And the most basic way of approaching this is to move a copy, right? And it's going to be the straddle combination. And by virtue of going down this route, we are able to keep the graph live and linked to the estimations we had performed previously when setting up the straddle. Now, to be clear, what we want to create this time round is a strangle, and we can use this as a kind of a signpost or guidance in terms of what we want to create. The strangle involves buying a put and a call with the same expiration date, but with different strike prices. And it should be noted that the exercise in the call will be lower and the exercise on the put will be higher. Now, from our perspective here, that's a simple change to make. If we put the call with the lower exercise and put the put with the higher exercise, right, we get that combination of the strangle, right? And we could maybe increase volatility, and the combination of the two here leaves the strangle. So you can see the call, you could see the put. We can remove for maybe each of these just to, so that the graph is possibly clearer. But the strangle here, the strangle strategy, we have a call and a put, the combination of the two, where the call has a lower exercise and the put has a higher exercise, produces this payoff. In other words, as the underlying value, as the underlying asset increases, we hit a break-even point, and from thereafter we make a profit. And as the option price, as the stock price or the underlying asset price falls, the option value also increases in value. So this is a volatility play, and obviously if we break out of a given volatility regime, the profits here become higher. Now, also if volatility increases, using Black Scholes, because we've used Black Scholes to estimate the premium, that will be reflected with a higher premium. So using a strangle strategy like this, it generally implies you anticipate a higher level of volatility that the market hasn't already taken into account. And if the volatility increases, then you profit from that. If we go back to including the call and the put here for a moment, you can see we have the long call combined with the long put. And when we add both of the payoffs here from those strategies, we get this combination of the two, right? Okay, so that's our strangle strategy. And again, it's worth noting that it can be used as a volatility play.